Welcome to the Final Bar. I am Greg Schnell, the host of the show. This is the show where we check out the most interesting charts to get set up for the following week. With some intermarket studies, we'll be finding out the inflection points for minimum risk and maximum reward. Lots to cover off this week, and thanks for joining me. There are some interesting charts out there. We're going to work our way through just to kind of lay the turf here for a little bit. I'm very uncomfortable with the current conditions of the market, so I want to lay out why. So today's agenda, a distribution day normally would have higher volume than the day before, but we had another selling day, and I'm going to talk about that a little bit. So I probably shouldn't have called it a distribution day, but I'll define those differences and lay that out. Transport, some of the components are going higher. Trucking had a particularly nice day today, and then the autos are really, the charts aren't nice on that particular sector. And then breadth data is important this week, and I want to show you why. And then commodities continue to weaken, and part of it's the US dollar, but a big part of it is just global weaknesses starting to creep into everything we're looking at. So let's go to, maybe I missed that button there. Let's try that. So as an example, this is one of the charts that I want to cover off today and explain the importance of this. So this is the DAX, which is the German stock market. And Germany's strongest country within the EU, or Germany is the strongest country within the EU. And if you look at this trend line, this is 2009. Nice touch in 2011, multi-touch in 2016, and then 2018 we've kind of been riding the line, but this month, and we're only on whatever, day 5 or 5th trading day of the month, but what we're seeing here is we're getting down into where we're breaking the trend line. We're definitely below the center of the monthly Bollinger Bands, and I think that's cause for concern. So normally, if I was to look at a global marketplace, one economy can start to slow, and that's not too big a deal. And we've seen that with the Shanghai. But now we're starting to get multiple of the major countries, multiple charts in the major countries that are starting to break down. And that's what I want to bring to light today and highlight why we need to be more concerned about that. So this is the DAX on the monthly chart, and we can see that it basically peaked in January, and when the monthly chart rolled over, that's also when the market broke. The DAX has tried multiple times to get back above the prior highs and has now set up this topping pattern. If we go to the next chart, this is the weekly chart, and here's 2016, this really strong trend line, and I mentioned that it was touching nicely. Here we go to early 2018, mid 2018, and now we're into the third quarter. And you can see we continually are testing this, and this week's been a solid drop below 12,000. Now we can get to 11.8 and call it that we have some level of support left over. But I think the one thing I want to point out is, when we noticed that the PPO on this weekly chart was going below 0, and then we bounced up and talked about this perhaps being the last major rally before we roll over. And now since then, we've been making lower lows, and this week, lower low, lower high, and now another lower low. So we're definitely starting to break down. We're below 0, and I get the feeling we're over here in this sort of time frame where we're starting to genuinely decrease. And here, let me just add a few more months on this chart. So what we see is in 2015, we were breaking down. The PPO went below 0, bounced up, could barely get it back above, and then went down. Now, what we don't know is how difficult this is going to be, but we're definitely getting set up for a bigger breakdown than we thought. And this is in Europe, obviously, not America. But what I want to talk about is how some of the global charts are all starting to shift. So if we go look at France, France has been consolidating much like Germany, and it's been a little more positive. And so far this month, we're just starting to drop below the 20-month moving average. And I've mentioned it before, but essentially one easy way to check the world conditions is just where is every chart in the world relative to the 20-month moving average. And if they're all above it, that's bullish. I mean, we're we're just a few trading days into September. So it's really hard for us to take a monthly chart and start to get too bearish, but we can definitely look at the weekly chart. But you can see in general that when we're above the 20-month moving average, it's a pretty good place. And when we're below it, we have very long candles that have lots of volatility. And so I would suggest as we start to go below this 20-month moving average, it's a better place to start thinking about increased volatility. And again, I don't know if it's, basically, do we pull down and then next month have a big throwdown, or do we have a big throwdown this month? But we're starting to get to the point that makes that is concerning. And in Germany, we were using a 2009 point for an uptrend, and you can see clearly that does not line up here, but we have the 2011, 2016 touch. We're nowhere near it in 2018 in terms of that trend line. And Macron, the Prime Minister of France, got elected right in here just as it was kind of breaking out. I think you'll see that on the next chart. So we have this declining momentum, and it's been going on for a while. We dipped below the zero back here in mid-March, bounced back up, making our final high. In this case, it went higher. In Germany, it didn't go higher. And now we're rolling over, and if we pull out the zoom panel here, what we can see is that the PPO is moving below zero. And anytime the weekly charts are moving below zero, it's just such a great place to be aware of momentum slipping. And what's important this week is we can see this very important trend line that we can go back and draw off the 2015 highs. And we've struggled to get above those. And this week, and we've got a day left, but that's why we do the show on Thursday, so you can prepare on Friday for what we're getting set up for next week. We're sitting at the low end of the range, and obviously they didn't have a great day. But what we want to watch for here is, does France follow Germany and start to make lower lows? And it hasn't just yet. So that's a condition. But again, going below zero on both France and Germany is a big deal. Now, the next chart I've got is set up for the Dutch Stock Exchange, and that would be the Low Countries, Belgium and Holland, Luxembourg. But you can see here, I've got a 2009 trend that touches in 2011, briefly dipped below in 2016. Pretty good tests all the way through the back end here. Tests in 2018. And now we're starting to slip below the line. So once again, below the 20-month moving average, not that good. Momentum is rolling over right where we might expect it should. And again, we're early in the month, so hard to use this as a big trading decision. But we're trying to set the stage that something is starting to break down, and it's not just in one or two places. We're starting to see it on weekly charts, and that German chart, I think, was pretty compelling with these big giant bars breaking. And here's the 2.5-year uptrend off the 2016 low. And sure enough, our PPO rolled over right where we might expect it to, probably a little bit higher. I had the line sitting on these two bumps down here before. But sure enough, we broke this little uptrend, and now we're rolling down again. In this case, we're still above zero, so that's bullish, or not as bearish. But I think the important thing to keep in mind is really, how do the markets perform tomorrow? Because in all of these cases for Europe, to break the trend lines this week, I think is an important step as we head into the fall. So hopefully I'm laying this out clearly enough that it's not threatening, but it's more of being aware that there's a big trend change happening internationally. What we see in the Shanghai market on the weekly charts is this continues to go lower. We broke support a while ago, so now that Europe is starting to follow that break in support, that's a bigger deal. And, we don't know when these markets are going to rally, but I would say that they're under significant stress at this point. And if we look at the Hang Seng, this is the monthly for the Hang Seng, but we've clearly fallen through this horizontal support line that goes back to 07. We're below the 20-month moving average. That's the gray dotted line here. The Shanghai was well below it. We've broken the uptrend in momentum here. So there's a lot of reasons to start to be cautious. And I think we talked about Asia at the end of June or July. And here we sit, kind of moving 1 month forward, and we haven't got a lot of action in the rest of the world. So here are the markets, breaking down this this is a pretty clear trend on momentum. And until we start to see some breakout, I think we need to start respecting that these other markets are going to start to have more influence on the US market. The Nikkei, obviously sitting next to China, has a very tight uptrend off 2012, nowhere near the 2009 uptrend. So a little bit like France in that respect. But we've got this nice uptrend. We had a huge gravestone doji to mark, or gravestone candle to mark the front of the month, or the front of the year, 2018. And now we're getting a sell signal. Again, this is early, but we got it at the end of last month, and now we're breaking down here on the PPO on a monthly chart. Anytime the monthly chart's breaking, you would at least want to be aware that it might take multiple months to play out, but we need to be aware of that. Looking at the weekly data, what we see here is an attempt to try and break through this upsloping trend line, and we pushed up and now struggling, and we're right at both the 10-week and 40-week moving average. We have a big uptrend line. We broke this uptrend line a while ago off the middle of 2016. So now I've got the shallower line in place, and we're still obviously above it. If I was to extend that out, it would be to call it 22,000, somewhere around there. So that's probably the level in the short term we need to watch for. But we're also getting this rollover where we can't get any momentum higher on the Nikkei. So it's these types of market conditions that I think make it more compelling to be aware of the US. The Australia market was doing quite well, and even with all their prime ministerial issues, it was a pretty important one. I went straight to the weekly here. But what you see is this is a huge, tough week for it. They're down around the 20-week moving average, which would be the center of the weekly Bollinger Bands. But look at this limit on the trend lines here. You could just see that the PPO continually gets caught at this level in terms of momentum, and it looks like we're rolling over again. So we had negative divergence on the RSI. We had a higher high in price and a lower high in momentum. And sure enough, now we seem to be pulling back. So all of these things are adding up to make it more significant, I think. And the Canadian market, which is obviously in the middle of the negotiations with the NAFTA issues, what we see here is we've been trying to break out through the January highs, and we briefly did it for a couple of months, but not with any real enthusiasm, and have rolled over. And again, it looks like we're going to roll over on our PPO one more time. This is a monthly chart. Let's go to the weekly. And on the weekly chart, what we see here is that same condition where we have a lower momentum on the most recent high, even though it was higher than the prior high. But now we've clearly lost our breakout level, so we'd call this a failed breakout. Now we're coming down to test this 2017 high. And if that starts to give way, I would suggest we've got a lot more problems. I did mention last week that I was concerned about the markets, mostly because we're starting to see Canada roll over, and not that that's a big shoe drop for the US, because the Canadian market hasn't made any money this year, and the US market's up around 8 or 7%. But the bigger issue was this was starting to let go in concert with some of the other charts. So it's that culmination where all of these charts are starting to move down. Now, Canada still has a positive PPO, but as I mentioned, Europe is now breaking down. Asia already had negative PPO conditions. So as the global charts weaken, I think that's what's going to weigh heavily on, more heavily or heavier on the US market. So here's the Brazilian market, and we all know they've had some struggles, but it's making lower lows every week. We're in negative conditions already there, and we're below our 10-week and 40 weeks, or sorry, 20-week and 40 weeks. So there's nothing really bullish about that chart. On the big picture, we're making lower highs and lower lows. We've got a negative PPO, so that would align now with what we're seeing in Europe and in Asia. In terms of Russia, this chart has broken the upsloping line on the PPO, so I think that's more of an issue. And there was a line that we broke a while ago that was back up in here, and we haven't done anything since then except grind sideways and now break lower. So we're breaking the 2-year trend line on price on this chart. Hopefully I'm making my point that the rest of the world is not only weak, it's getting weaker. And the problem with it is we're just starting to get the below zero PPO, which is a very good place to add caution to a portfolio. Okay, let's go in and look at the S&P. What I want to show you on the S&P here is we had this big pullback, and then it was in here that I said, you know, we want to be cautious on this momentum. Well, we pulled up to here, and then we started to roll over, and it was in here that I thought we might get caught. Well, instead, we've pushed all the way up to the top end, and now it looks like we're struggling to hold our breakout above this high. So our high in here was 28.72. And we're at 28.78 as our close today. So not that how we close tomorrow matters within pennies. The issue is we're continuing to test this high, and if this high is a fail, and you can see we have a lot lower momentum on the RSI at this point, if we end up having this divergence with a lot lower momentum here and a slightly higher price, it's that divergence that will become more important. So the last couple of months, we've continued higher here, and I wasn't so sure that we would be able to do that. Recently, the breadth started to improve. So now I want to get in and discuss the breadth on the charts, and maybe we should just look at the NASDAQ real quickly while we're here. So what we see on the NASDAQ is we're nowhere near low. We have lots of momentum up here near the top. And if this was to roll over, we still have, you know, a PPO way up around 3%. That's huge. And we've been up here for a long time. Now we're making a lower high in momentum, a higher high in price. It's a place to be aware of. But at this point, you know, it's hard to say that we're going to have this kind of significant drop in here for the U.S. markets. Maybe it goes on for a few more months. I will say that as 2015 came in and we started to see weakness in other parts of the world, this started to pull down more, and then the U.S. continued to try and make a higher high in here and then fell down. As I mentioned, you know, Germany is unable to make that higher high so far. And so what we're watching for is, you know, do we end up having a slightly higher high here and give it up and end up pulling back a little bit more extreme? I don't know that. I would just say that the global conditions are ripe that we might be more influenced in the U.S. than we want to be. And the one thing I think might be telling this week is this big, for the sake of discussion, reversal bar where we pushed up to a higher high, opened with a lower high, have now made a lower low. And I would just say that looks a lot more like what went on in January. So it doesn't have the same strength that I think the overall market believes. But at the same point, we haven't really started any major sell-off. So I'm somewhat concerned about the strength of the market. I do want to show one thing here, and this is the Hong Kong market, just the ETF that trades for the US in US dollars. And what you see here is this continued smooth, steady decline. Even in US dollars, we're seeing it. So if there was a big currency differential, we'd start to notice it. But what we're seeing is, you know, it doesn't matter if we look at the local currency or on the ETFs, these things are making lower lows and lower highs. Let's just run up to the breadth indicators. And the reason I want to show these is not so much, maybe I'll start with Canada just for an example. And the idea being here that we have this slowdown in momentum, and we've been making lower lows and lower highs. And so far, we've kind of been holding up around 55% in terms of bullish percent. And so we're right at another key level here. And again, if we don't bounce at these levels, this is a good place to expect lower for longer, much like 2014 or back in 2011. So this was a triple bottom, I'll call it, and then we broke down. And this is a triple bottom setting up here. So we either need to bounce and start going higher quickly, or we have a problem. And we have the same condition in terms of the percentage of stocks above the 200-day moving average. Now, we don't have a Friday close, but we are down here below 48%, or below 50% at 48%. And just in general, when you're below 50%, you're in a pretty weak market. So the Canadian situation is looking more tepid than the US. Now let's go up to the US, and the reason I wanted to do this one first is we're starting to get this same sort of downtrend in bullish percent index, and we've seen this back in 2014. Obviously, it got a lot weaker, but we stayed up around 50 and 60% on the bullish percent index, and the market was able to continue to grind higher on the back of some of the really big stocks. We also have this same downtrend showing up. You can see it in the Zoom box here, but basically since the beginning of the year, going back to the January high, and we have lower highs and lower lows. We're around 55%. So we still have, 5% of cushion, but it's worth paying attention to the fact that we're getting weaker. And so again, if we turned and broke out here, that would be bullish. And I kind of thought we were starting to do that recently, but it was one of those where we end up rolling over just as we get to the critical levels. This is the NASDAQ 100. And again, these are the really big stocks. 59% of them are on a buy signal. So that's hardly as robust as the 80% we had back in January. And we're down to 64%, which is still very bullish. 2/3 of the market are above their 200-day moving average. So that's pretty strong. But you can see here that there's a, if I drew the line like this, it's a downtrend. If I drew the line like this, it's a downtrend. More importantly, we have lower lows coming in all the way through here. Now the question is, can we rally and hold up? It's starting to look more suspect. On the New York Composite, what we see here is we haven't been able to get back inside my golden zone. I like it when it gets back between these two red lines, and these are lines that I've just set up. But getting back above this 65 level is pretty bullish. We haven't been able to do that. We're sitting more around 60%, still okay. But you can see here, we've been just kind of stalling out at this 60% level, and the market can hold up here for a while. But I will point out in 2015 that it was kind of at this level that we ended up topping out, and that was after being deeper, came back up and then gave it back. And in 2011, kind of as we broke through these levels, it was important. And in 2007, we stalled at the same sort of final high after being lower, came back up and didn't have enough horsepower to get going. So this is, this setup here, I would say this setup here looks quite similar to what we've got going on. And it doesn't mean that's the way it's going to play out. I would just suggest that for the New York Composite, it's starting to show similar conditions. So here's the S&P 500, and this is just such a stalwart of big companies. And Arthur Hill and I were talking, and Arthur said, it's like the little engine that could. And I would say just the opposite. It's like the big engine that just doesn't change. It's more like an aircraft carrier. And when it's in motion, it's very, very powerful. So we're still above 67% on this chart. And then down here, we have, this hasn't updated for today yet, but 67% of them are still above their 200-day moving average. So of the top 500 stocks out there, 67% are still bullish and 67% are above their 200-day moving average. It's pretty strong. Looking left on the chart, you can see, this is kind of the area that the market has broken down from before. In 2007, this is the area that we got stalled at, where we fell apart. And again, when everything seems so good, that's what makes a market top. And then all of a sudden the market seems to start weakening, and we're unsure why. And my concern here would be, just that we haven't had that much enthusiasm in terms of, considering at the beginning of the year, we were 80% of our stocks were bullish, now 65%. And that's after 3 or 4 months of grinding higher from April 1st. So all of these things add together and make me want to at least point out that we have some issues in terms of breadth and strength. I'm I'm going to cover off the advanced decline line very briefly. Again, I find that this line rolls over pretty much the same time the markets do. It was declining in here and then went on a sudden surge, and now we've pulled back here. And you can see that the NASDAQ composite is right at its uptrend. So if it was going to bounce, we would expect it probably to bounce right off this line. It's been holding up for 4 months. And so I think tomorrow's a test and next week, and we'll see if we have the enthusiasm to push it back up above. In terms of high-low, again, we're okay. We got a little bit of bullish enthusiasm up to almost 200, but you can see back in this 2014, 2015 period, we had sudden spikes that still gave us an uptrending market, which is this gray line here. And I mean, this is a railway to the higher ground, so it's hard to call anything bearish until we start to see much more tepid net new highs. But so far, we're continuing on strong. Looking at the New York market, it's not quite as rosy. We're already in negative territory in terms of the moving averages. We've already had a failed breakout to the index on the index highs here, and the advanced decline line is still holding its uptrend. So again, if we started to rally next week, that wouldn't be a surprise. For the high-low, kind of struggling around the 75 level, so not quite as robust as we'd like. And the same thing down here in 2018. We just haven't had a lot of net new highs to kind of push the market up for the New York composite. And that kind of shows in here where we're just stuck well below the prior highs. The Canadian market, just to show you how this chart looks when it starts to get weaker. So we're making a series of lower highs and lower lows. And the advanced decline line, this is the moving average of the signals. We're back down here, and this is a typical place level where we would expect a bounce unless we're really going to start into a big decline. So I would say Canada's got some work next week. If we're going to start falling apart, this is probably where it's going to set up. Lastly, the high lows for Canada, again, kind of got this shaded area, and we've had trouble making any real net gains. So here we are with negative net new highs. So we're making more net new lows, or making more lows than highs. And so in the net, we're actually negative. So you take the number of 52-week highs minus the number of 52-week lows, and that gives you what this calculation is on a daily basis. So far, we've been negative recently, and not a lot of strength over the last couple of months, pretty much a declining line here in terms of relative strength. So this brief little blip that Canada saw broke out and immediately rolled right back over. So that isn't good, and now we've made another lower low. So we continue to see these markets break down. Just as an example, so we could pick copper or whatever, but this is Cameco Corporation, and it's a uranium miner, and you can see it's breaking down. We could pick X Corporation, US Steel, and it's making lower lows. And we can go through a lot of the commodity charts, but they're definitely getting weaker, and we're starting to see the same thing in some of the energy stocks. So with all of this piling up, I think the biggest thing that I'm worried about is that this might end up becoming a tougher September than we first thought. I don't have a feel if that's the way it's going to play out, but I do have a feel that we're definitely set up for it, and it shouldn't surprise us if that was going to happen. So with that, I'm going to say thank you for joining me on today's show. The final bar airs live on Thursdays at 5 p.m. Eastern. It can also be found on the StockCharts TV schedule at other times during the week. In addition, you can look for it on the StockCharts YouTube channel. And with that, have a great weekend and good trading.